Well, I think one of the, if you may say so, fallacies is that people are over-focused on what is the Fed saying and what is the immediate policies. Because the reality is, I have written about this recently, not very long ago, and what I said is that there is no hope for Fed being suddenly dovish on their own. They will change policy when the data changes, which it will. But you cannot guess when exactly it will change. But we saw even this one soft CPI print just a few days ago, how much it would change the whole perception of the world. So the whole mood and perception changes quickly, yet it will take some consistent flow of data to drive them. So what they're saying is pretty much one of the things people think that it's relevant, what the Fed says in terms of what the Fed officials say in terms of the guidance, but it's actually not. It's the data that is relevant. They just follow the data. We can kind of understand how they will react to various types of data over like watching them over this year. We know that they will react to employment and inflation numbers, but in the end, it's not the Fed policy stance change. There will be no pivot. There will be no change. There will be data change. So that's, I think, the very first thing to understand. And the other thing with regards to understanding inflation, which I think people tend to forget, is the huge time lag which transpires between the time you can implement any policies that would affect inflation and the actual reaction on inflation. It's very hard to get, it's very hard to think about it, and it's very easy to get into the patterns like, okay, Fed raises rates and inflation is still high. Let's raise some more. Inflation is still high. Damn it, let's whack it some more. Mm-hmm. And they keep whacking at it. And even though they know better, but it's one of those things that people cannot get out of this mindset, even if they know better. The inflation today has nothing to do with any policy choices that happened this year. It has nothing to do with whether the stock market is up or down this year. All of this is a product of monetary and fiscal expansion that happened in 2020 and 2021. There is nothing Fed could do at all this year to change inflation trajectory this year. The only thing maybe they could incrementally affect the energy prices by just creating sentiment in this market, but even that market was driven by events not fully under the control of the policymakers, such as wars and technological cycles with energy industry. So having said that, it's very important to understand that we are not seeing right now any effects of the recent Fed tightening or the recent fall in asset prices. All of those effects will be seen a year and 2 years from now. And I think reframing it that way would very much change how you think about inflation. Yeah, that's a psychological bias that even smartest people cannot escape. You get biased by the mood of the market. For example, you get this weak CPI print and everybody's great, hiking cycle is over, party on. Yeah. Then when market starts moving in your favor, it's very easy to imagine that it will keep doing that. And when market goes against you and like kind of what people are talking with you, it's very easy to get despondent. So same thing with inflation. Like when inflation rises, it's very easy to get into this mood like we are in an inflationary crisis. Look at this year-on-year CPI number, which actually doesn't tell us what inflation is. It just tells us what inflation was. But it's very easy to confuse what was with what is. And on this thing about it is easier to over-tightening, honestly, I find this whole logic befuddling, because they say that it's better to over-tighten than not tighten enough. But what I would wanted to challenge them if I was in a press conference room, what examples he can give when they went through tightening cycles and stopped tightening too early. And I am almost positive that there are no such examples since 70s.
Okay.
But it's definitely not in my career, which started in the 90s. Whenever something is before your career, it's harder to like feel the zeitgeist, right? So anything before 97, I'm not as sure about as what after 97 when I followed market every tick for the last 25 years, right? And I'm positive that in the last 25 years, there was not a single instant anywhere in the neighborhood of the instant that they didn't tighten enough. Every single time the tightening cycle they went through went too far. Every single time the last tightening, last tightening was just completely wrong and obviously wrong and retrospectively wrong and wrong at that moment. So I don't know what makes him think that there is higher dangers of not tightening enough, what logic he's using, and the only logic I think he might be using is that what I'm saying, just to be devil's advocate and just understand other person's point of view. We were in a certain environment for the last 40 years, on this kind of disinflationary environment when stocks and bonds basically marched up with corrections, but we're marching up. And if you think that in a different kind of world, you maybe have to go 50 years back to find examples. So maybe my guess is that maybe he's thinking that you do need to go 50 years back to find those examples when you didn't tighten enough. Because that's the best I can fathom how to understand that logic at all. Possibly, but I think his confidence is slightly misplaced here because, I mean, it could very well be true. They indeed have tons of tools to stimulate economy. That goes with, but I also think similarly that they have tons of tools to tighten monetary environment. All they have to do is reduce their balance sheets. To me, actually, interestingly, it's easier to fight inflation than to stimulate, because all they have to do to fight inflation, all they had to do, in my opinion, was just start reducing their balance sheet much earlier than they did.
Right.
Like retrospectively, what I would tell them to do, I would tell them in 2021, start selling the bonds, right? And that would be both good for the just the balance sheet, for the P&L, because they would sell the bonds before rates go up and so on, right? And that would tighten monetary conditions earlier. And they still have trillions of dollars of bonds that they can sell if they somehow feel that they cannot tighten monetary conditions enough. On the flip side of it, on the other side of it lies the liquidity trap. That is, you cannot get rates below zero. And the reason why they were able to stimulate the economy successfully in 2020 is because they also had a huge fiscal impulse, which may or may not be here this time, depending on how the politics go. Like the government spent a lot of money sending checks to people. It was not just the Fed.
Yeah.
And I don't know if the political will is there, right? And secondly, they were able to act very quickly. On the contrary, in 2007 and 2008, they actually acted very slowly. They were incredibly slow and incredibly resilient to low interest rates and provided stimulus, and the stimulus was tiny compared to what happened in 2020. And as a result, we got a fairly deep recession and a fairly sluggish recovery. But what is happening now is way worse than what is happening in 2007, 2008, because at this stage, normally we would already be stimulating while we're still tightening, which makes me think that this recession, and the other thing that is happening is that we're having recessionary conditions in other major economies in the world, in Europe and China. So I feel like disproportionate risk of us being really protracted recession and even very disproportionate risk of global depression. Well, so first of all, I just want to be clear, my statements are not political. So I don't like right now talk about who's doing better job or worse job. But what I really mean about that is that unlike what we had last 2 years, we have a divided government, for better or for worse. There is still
right.
Which it does not mean that no stimulus bills can be passed. But what I think is that anything very radical is much harder to pass anything radical, because anything significant and radical could be blocked by Republicans. And I think given that there is still some inflation hawkishness going on, seeing major stimulus right now, it's hard for me to see. There will be some measures, but I just don't think they'll be radical enough. Like nothing as radical as 2020 stimulus, I think, can be passed quickly enough. Yeah. And the question is, and it's very hard to guess, how will those things work against global headwinds? But that's why I'm saying it's not like I know that there will be global depression. I'm just saying that the risks are elevated because central banks are still tightening into global slowdown, into the shrinkage of dollar supply, and into the idea that the world is not making enough energy to support global growth. We don't have enough energy produced to support global growth. And there is not enough dollars to buy energy at the current energy prices.